Without further ado, I will ask Jeff the very first question. All right. So far, everyone happy with the STI break 4,000 point? Like that only. Jeff, I don't think the bullish trend can continue. Come. Anyone happy or have a euphoria of 4,000 point? Happy, right? Do you want to go higher? What's the price target? Do you know? Do you want to hear from Jeff? Right, what would the price target by end of this year? So this will be a question I'll be posting to Jeff. Okay, Jeff, why and how STI can break the 4,000 point? What are the key drivers? And also whether this can be is sustainable. Every one of you want to be sustainable, right? So they can go higher. So that's the first question. And the second question to Jeff would be, what would be the price target by end of this year? Okay, Jeff, hand over to you.
Yeah, I can answer that pretty quickly. Before I do, just to ask everybody a quick question. Anybody remember when the STI broke 500 in January of 1973? I think I was 11 months old then. But I was reading up on it because I had to go through the NLB microfilm to check out the history and so forth as we get closer and closer to, I guess, 50 years of when the STI in its current a numeric form started, and it was actually in the beginning, first few trading sessions of January 1967, and we had an index because we had joint exchanges then, Malaysia and Singapore, and we rebalanced it at the end of 1966, which our trading day was December 30. So when you look at the STI at the moment and where it closed today at 42.74, and you want to know when it was at 100, it was the close of trading on the 30th of December 1966. You work out annualized price returns over those 58 years, it's about 6.6% thereabouts, not including dividends. Where it is right now is 42.72. The all-time high is 42.74, so we're very close to it. Where it goes from here, the biggest, you've got a lot of macro factors which we can look at, but I want to stay on point with your question. Where's it going to go? Well, at the moment, the consensus estimates for where the STI will be in 12 months is at 45, I think 40, it's either 45.03 or 45.08. So at the moment, analysts are as bullish as they have ever been on our STI. Now, when we got to this 4,000 level thereabouts, particularly in the second quarter and into the third quarter, whether we had legs to continue to sustain and keep going with, you would have heard some market strategists at the banks talking about a 46,000 level, 5,000 was even touted. But for it to have legs to keep going higher, you had to basically, in our market, you had to see how we fared with the earnings and whether the analysts had reason to upgrade their forecast prices. So we've kind of got it, but not like we would have hoped because the banks make up a majority weighting of the STI. And how I'll explain this is DBS beat estimates, OCBC met estimates, UOB missed estimates. Now, DBS did better than expected, predominantly because it has a very proactive hedging mechanism to hedge against the declines in their net interest margins on the back of falling rates, whether it's US dollar, HIBOR or SIBOR, okay? Now, they did really well and in their results, and therefore saw analysts upgrade their price forecast on the stock. So that meant that the share price estimate of DBS rose about 8%. Now, DBS makes up 26% of the STI. So if one stock alone is upgraded, its target price is upgraded by 8%, and it makes up a quarter of your index, then your index target price is also going to get upgraded 2% because it has such an important part. So that's why, at the end of the first quarter, we had pretty bullish estimates. I think around 43.60 was the target price, 12-month target price. And we hadn't got back there, even though the market had recovered from those first 2 weeks of April. And then with DBS's results, we've got a higher consensus estimate target price. So at the moment, your target's around 4,500. At the moment, we're around 6% lower than that, but things will change as the outlook for interest rates, for trade and second order impacts of tariffs, and of course, geopolitics change the momentum of the market. So that's where we are. We've had a really strong rally over the past 18 months or so, strongest charge ever, broke a 17-year high. STI rallied close to 25% in the 12 months ending June. It was very broad-based gains over those 12 months. I think you had 4 gainers for every 1 decliner. And, recently, this year, it was the banks last year. This year, it's the industrial stocks leading it. So there is an element of diversification that is able to kind of capture some of the cyclical trends, some of the structural changes, in particular the industrial sector, that have created very vibrant circumstances for many sectors, which is competing, of course, for the investors' appetite when it comes to the REITs as well.
Jeff, do you think the institutional fund has already returned to Singapore? Because based on the fund flow published by SGX, what would be the percentage of the retail investor fund flow versus the institutional fund flow? Because as I know that actually for S-REIT sector itself, the institutions still have not come in yet. Basically, the S-REIT sector is purely supported by the retail investor.
I'm just going to put this up here. From an institutional fund flow, there's money coming to Singapore because for much of this year, we've had the world's strongest currency. So, obviously money flocks to Sing dollar. Then money has to be deployed in Singapore. When you've got stocks like DBS that have such a strong dividend and sustainable dividend, it helps attract those net institutional inflows. But it's interesting because the banks dominate the net interest inflows, net institutional inflows, I should say, the net institutional inflows. The banks actually dominate that on a day-to-day basis. So when you take out the banks, you've had quite close to $1 billion of net institutional inflow into our stock market this year. And of course, they dominate because they're so big. DBS market cap around getting close to 150 billion Singapore dollars. So whenever we look at net institutional inflows, it is really important, I think, and more of the institutions are doing this now too when I see their reports, is to anchor the size of the net institutional inflow or outflow to the actual size of the sector. So even though you have, let's say, $2 billion Singapore dollars of net institutional outflow from the 3 banks, the size of it's so big that $2 billion only represents like 0.8% or thereabouts of the overall size of the sector. And therefore, you can actually see some of the trends a lot more clearly. The banks, as I said, dominate it. What drives that is re-ratings first and foremost. When you have re-ratings, upside re-ratings or downside re-ratings, the upside re-rating to the stock obviously attracts net institutional inflow, and the downward rating or downgrading sees net institutional outflow. Also, they also seem to correlate directionally with interest rates. So when SORA is coming down from 3% down to 1.8% this year, that's also creating a reason for net institutions to actually pull out of the banks and not invest in the banks, because generally our 3 banks, about 2/3 of their income comes from net interest income. Okay, there's non-interest income, which is all the wealth management, treasury activities, cards, and so forth. That's 1/3, but 2/3 is the net interest income, and the net interest income really is driven by net interest margins and basically being able to benefit from higher interest rates, basically being able to charge more for their loans than they have to pay on their assets. And at the moment, when you've got these falling interest rates, you're seeing those margins or that net interest income being squeezed somewhat because the loan growth or the delta in the loan growth is not big enough to offset the decline in the interest rate yield that they receive, the premium in the yield that they receive. So that's what really drives a lot of the flows. Then, as I said, in that last question, there's a lot of cyclical and structural factors that matter as well. The sector this year in Singapore that has attracted the most net institutional buying is the industrial sector. I call it the industrial value chain. These stocks, for instance, we've got so many. ST Engineering has led the STI this year, and that's been, I guess, a real standout. And it's got I think, close just under $9 this year. Yeah, it's an interesting stock because I think it embodies the three key themes that are really driving the industrial sector at the moment. The first is realignment of supply chains. There's a push in some instances to increase manufacturing in the US and also service those supply chains that might be headed back to the US or being fortified in Southeast Asia. ST Engineering made a very big investment in the US in 2019 into Middle River Aerostructure Systems, which is a 2 million square foot plant about 10 minutes north of Baltimore. So it's employing about 600 Americans to build the nacelles around engines, plane engines, for, General Electric plane engines and so forth. So it's exemplifying too, in many ways, exactly what the Trump administration is trying to do in reindustrializing the US. And it's also engaging in critical technologies. Minister Gunn was there a few weeks ago looking at the technologies they're using to increase productivity. That's in automation and AI automation and robotics. And then, of course, you've got such a apart from ST Engineering, you've got such a strong public and private construction pipeline in Singapore at the moment. We're having that spike up this year, up around the mid 50 billion level versus sub 50, 45 to 50 on a usual basis. So there's those are the three key factors that are driving, a lot of interest in the industrial stocks at the moment. The very strong construction pipeline at home. You have the realignment of supply chains, and you also have AI and critical technologies. And I really mean it with the AI. The little picture there I took from the Edge magazine, and that's just up the road on 8 Shenton Way, the foundation for Sky Tower, which is going to be our tallest building in a few years in Singapore, integrated, commercial and hospitality and so forth, as you can imagine. That concrete pour, 10,000 cubic meters, I think it was. It's over, I'm pretty sure it was 10,000 cubic meters, not 10,000 cubic feet of a concrete pour that took 35 hours continuously using AI to make sure every nook and cranny was filled and that foundation was built. And that's Pan United. You can see it about halfway through in that chart. Last year, it traded just short of $80,000 a year on an average day. This year, it's trading over $400,000 in liquidity every day. And also, booking net institutional inflow at a rate that's maybe close to twice than what we saw last year, while the liquidity is up fivefold. There's heaps of examples of this. ISO team is going to be using its drones very soon to do the painting of the HDBs, saving about 40% in costs. I've got 10 examples I can just roll off of a number of these stocks that are employing such technology to increase their productivity. So that's the sector that's booked the highest net institutional inflow. Industrial stocks, as you see, it's not just a Singapore phenomenon. They're also led the world and outpaced technology stocks in the US this year as well. So it's, reindustrialization of the world is great for industrial services. Our stock market is blessed with a lot of industrial services, and you've seen turnover and liquidity increase phenomenally in many of these stocks. There's one stock there, Hyap Seng Industries. 1L2. That stock, basically last month, it was reported or filed, I should say, that Chandra Asri, one of the subsidiaries of Siam Cement in Thailand, increased their stake from 4% to 12%. And during that month of July, the stock saw more trading turnover in the month of July than it had cumulatively every day for the last 10 years before July. So, I was saying, I've always kind of said, industrial stocks are our sleeping giants in Singapore. They're a large part of the market, but they generally have that low turnover. Case in point is we've now just launched this week a FTSE ST mid cap and small cap index. You've got half as many industrial stocks as you do real estate investment trusts. The market cap of the industrial stocks is 60% of what the real estate investment trust market capitalization is, but the turnover has been the same for the industrials.
Right. I can see that there are many small and mid cap has rallied recently.
Yeah.
And they're really supported by the 5 billion equity plan by the government, our MAS. Do you think that whether this plan can continue to attract more investors instead coming back in? Because so far, I think we only deploy about 1.2 B.
Yeah.
There's still 3.8 B to go.
And we want more. I mean, the whole point of the allocations to Vander Fullerton JP Morgan Asset Management is that these funds can crowd in more money. And this is what we're seeing at the moment too. I've been in the business in the financial markets for close to 30 years. And that adage, cliche as it is, flow begets flow, liquidity begets liquidity, is so true. It's definitely a number of stocks have been repriced. Some of those stocks, have seen that you can see there, have seen their PE reprice from single digit to in the mid 20s just since the end of May. This has happened, and I think it is on anticipation of our fundamental structural problem of not having enough liquidity in our mid to small cap stocks being addressed. And I think we should be able to achieve it. What we're trying to do, it's still going to be a lot of hard work. But you look at it this way too, that for a long time we've been challenged with our stock market and that we don't have a huge economic hinterland. Let's say like Hong Kong has China, or you have Australia, UK, the developing countries in Southeast Asia have a big population to fall back on and quite, spread out economies and so forth. But we're so closely tight in. We're a city-state. We're all neighbours, effectively. We should be able to communicate and get this done if anyone can, address and fix this stock market. So we're working really hard to ensure that if this is the anticipation, we've got to make sure we sustain it.
So Jeff, last question. All right. So what would be the sector that attractive moving into the second half of 2025? Beside the bank sector, you have already mentioned the industrial sector. Where else? What other opportunity?
Yeah, digital banks is really interesting. I've got this. I've got this chart here where I've been tracking. Remember, as I said, net interest income's on the top. So you can take those three banks and work out that for the last 11 quarters, you've had 8 billion Singapore dollars combined of net interest income. And when you combine it for the three, you can see the pattern. You can see how it's, in particular, see how the bars are kind of, the three of them all together, that they're evening out around 8 billion, but that purple line, that SORA rate in Singapore is coming off so quickly. That's a concern. Now, DBS has, as I said, they've been very proactive in hedging their interest rate exposure. So that's why they saw the least decline quarter on quarter in their net interest income. It was only down 1%, where the other two down 3%. The bottom chart is the interesting one because that's the non-interest income. That's also increasing significantly. So we've now had 4 quarters over the last 6 quarters thereabouts, or the last 5 quarters, of combined non-interest income above 4 billion Singapore dollars. And last month was the third highest. This is, as I said, wealth management, trading activity, and cards and so forth. And one sector we're really keeping an eye on is the digital banks and the payment system, because you've got digital banks in the rest of the world that, like Nubank, which is Brazil-based but looks after all of Latin America, that really has, the valuations that many fintechs really want to get. Basically a PB ratio that's around 7 times or close to what iFast has, which is much higher than DBS, which is great at 2, and the other two banks at 1.3. And ROEs almost double what our banks are on average as well, because they're so asset light. Now, what this is, however, you've got these, how I explain this flow chart is you've got the 5 traditional verticals of your banking value chain: customer acquisition, product offering, transaction processing and payments, risk management, compliance, infra, and IT. Now, cloud computing, really important on the infrastructure. DLT is really important, AI, but it's APIs that really make everything happen. And you might have followed what the MAS put out a little while ago, within the last month, about getting access to getting the sector access to best standards in terms of API development, because that transcends the whole bank value chain. It's something that, this is a paper going back 10 years that when we first started looking at this, they put out a periodical table of all the different APIs that are involved in digital banking and payments. And there's so much there. It's quite a very dynamic sector that I think will be really important. At the moment, we've got iFast, which is listed. And iFast, of course, has been one of our best IPOs as well since December 2014. Its annualized total return is somewhere between, I think, 27%. It was somewhere between 25% and 27%. Not the best IPO in that interim. That was Propnex, which I think was in 2018. Might have been June in 2018. And that's at compound. That's annualized total returns around 30% over that same time. But you can see a like a general pattern here. Those sectors are very asset light, not big industrial sleeping giants, as we said, but very light businesses that really target high ROE and high efficiency and really making use of critical technologies. The other thing is, in China, the consumer sector is still one that I think will continue to make solid headways. It has been resilient. You've got the NDRC Deputy Chairman, Lee Chun-Lee, who is basically spearheading the whole drive to make more demand-sided concessions at the government level to improve the ability to spend in China. For a long time at these events, I've touted how China is looking to produce new sectors that might not have existed 5 years ago, but will exist in 5 years' time. One of those is, of course, that blend of traditional Chinese medicine and Western medicine, and Tianjin Zhongxin Dareng Pharmaceutical Group has been a key beneficiary of that. I think its share price is up from $2.15 to $2.15 up to $2.89 this year. So, I think, and the big takeaway, I think, I really from the last few weeks was when Treasury Secretary Scott Bessent was talking about China, hinting they would do a 90-day continuation pause, but also saying that the US was actually looking at a way to help China with its consumer growth and to basically try and get a win-win out of trade deal.
Okay, thank you, Jeff. Okay, before I move on to the S-REIT, if you have any question for Jeff, those are the QR code on 2 monitor. You can type in your question later, we'll address it. All right. So the next session, I will start with on the interest rate, right? So I believe that most of you come here because you want to know where to park your money, correct? No response. Are you attending the right seminar? Okay, so basically I will show you a few charts, right? 1 year T-bill is coming down fast and furious, right? If you still do not know actually T-bill is coming out fast, that means that you are really not paying attention to what is happening on the interest rate. So you can see that at the present moment, the trend is still continuing to come down and there's still no stopping yet, right? Whether this trend can continue to come down below 1%, later I will show you what would be the possibility. Jeff, what do you think? Do you think that the T-bill you come down to close to 1%?
Yeah, I think that's the way it's headed.
Yeah. Both of our bill, we think they good.
But one thing, just one thing that has come to the attention recently is that the Fed is expected to cut. We've had a flip over the last couple of weeks, but now they're expected to cut by up to 75 basis points at the next 3 meetings before 2026. And there's expectations that, okay, if the Fed then cuts, then your HIBOR and your SORA come down as well. Not necessarily, because they've been coming down all this time. So, yeah, that downside from further Fed funds rate cuts is not necessarily going to translate to a lower SORA.
Right. There is actually divergence. If you pay attention to the US interest rate and also Singapore interest rate, there's a divergence. US interest rate is still maintaining very high level, but Singapore rate is really coming down pretty fast. And this one also can be seen on the 10-year risk-free rate. If you know technical analysis, you should know that this is a triple top formation, and they just broke it down from the triple top formation, and the 10-year risk-free rate is coming down. That will drive the Singapore saving bond. That's the reason that Singapore saving bond, the interest rate also coming down. And what I think that the rate will continue to come down. If you look at the past 10 years inflation trend, Singapore inflation now coming get to 1%. It may go even lower. That will support the further easing by the MAS. Right? And where are the opportunities? So this is a table I compiled for the past 2 or 3 days to scan through what are the yield opportunities in Singapore. If you have invested in the T-bill or Singapore saving bond, basically you will be getting 1.69% for a 6-month T-bill, 1.66% for one year T-bill, and Singapore saving bond for the first 3 years only 1.71%. And this rate, based on the current projection, will continue to go down, right? Because the inflation is easing. But do take note that if you want to move your money from a T-bill, from a Singapore saving bond to other asset class, those are not risk-free. Right, so there are some risk premium involved. You really want to look for other asset class. Even the money parked in the bank, the fixed deposit, you park in a Maybank, park in OCBC, those are not risk-free. The bank will only guarantee you the first 100,000. So do not assume whatever money you park in the bank, if one day the bank go bankrupt, you can get back all your money. Okay, maximum you can claim back is about 100,000. So other asset class, okay, because today is a Tiger sponsored event, that's why I need to sell a big koyo, right? Under Tiger Wolf, the money market fund at the present moment for SGD about 2.74%, right? This is where you can park your money there if you want to. Of course, the best way to really move your money will be the CPF, ONSA, 2.5% and 4%, right? Then the other asset class will be some of the bond fund, low-cost bond fund, globally diversified, 3.52%, short duration, a Singapore bond, 3.46%. If your risk appetite is higher, you can look at the iShare Asia High Yield Bond ETF. And this ETF actually is listed on SGX, right? Go there and take a look. You'll be getting about 7.8% yield. If you want to look for active managed fund, you can look for the BlackRock Asia High Yield Bond Fund, right? Of course, the CSOP IH REIT ETF at the present moment also, also this ETF has the highest DPU yield, right? later Bruce, you talk about it, right? I think he has a chart to compare the yield versus all the different ETF, right? You can look at his comparison table. If you're accredited investor, there are another asset class which is in the private credit space, no price volatility. All right, basically you don't have any price movement. Can give you between 7 to 10%. Okay, but those are for the accredited investor because they are unlisted alternative investment. All right, so I just want to point it out that although the interest rate for US will be coming down, but it's not necessary all the REIT will benefit from the interest rate cut. Okay, the reason being is most of the REIT at the present moment, they have already refinanced their debt to the longer debt maturity, okay, because they are not going to refinance immediately. And at the same time, they have already hedged high percentage of their rate into the fixed rate. Okay, so you can see from the bubble chart over here, most of them have already refinanced onto the right hand side. You can see that on the y-axis is the debt maturity profile. The longer, the higher the debt maturity, basically they need a longer time to really have opportunity to refinance the debt. And also they have a high percentage of the fixed rate. Okay, if you are able to see the big bubble on the right, the big bubble on the right, okay, the biggest one, yellow bubble, that is the CapitaLand Integrated Commercial Trust. The debt maturity profile is about 4 years, and up to 70% they already have a fixed rate. So no matter what happened in the market, if they drop interest rate, they may not be able to enjoy the rate cut immediately. All right. So if you want to get this chart, right, you don't need to take a picture. You can go to the REIT Survey website and you just play around with it, mouse over it. You can see all the financial ratio of each of the bubble. Okay, so only those REIT with which have already short debt maturity profile, which means that it's on the left hand side. Okay, sorry, my right hand side. Okay, have a very low fixed rate, then they'll be able to enjoy the interest rate cut. So at the present moment, there are not many of them. So in short, do not assume when the interest rate start to come down, your REIT will immediately going to see the improvement in DPO. It's not going to happen this way. All right. Okay. This presentation will show you why. On the left hand side, this is a debt maturity profile from Digital Core. You can see that 2025, 2026, there are actually no debt is going to expire. They don't need to do any refinancing during the near term. The earliest refinancing will be in 2027, and also big part of it coming from 2029. So interest rate cut, they're not going to enjoy it. But on the right hand side, this is the debt profile from OUE REIT, and close to 35% of the debt to mature next year. They have to refinance to the later date in 2030, and the OUE REIT, you're going to enjoy the rate cut, right? Because they are able to refinance at a further date and at the same time enjoy the lower interest rate. Okay, so at the present moment, Jeff, based on the institutional fund flow, right? What I think that probably the only reason is the US 10-year risk-free rate is still staying above 4%, right? Then at the present moment, my view is unless the US 10-year risk-free rate is coming down, which I'm not sure whether it's going to come down. What is your view, Jeff?
No, it depends if the US can pull off what it's really trying to achieve. You know, at the end of the day, the tariffs are not necessarily a dead weight loss. You know, the US is now banking $30 billion a month in tariff revenue. That's going into the world's biggest consumer-driven economy that is looking at redistributing some of those tariff revenues into a dividend. So there's tools for the the Trump administration to try and continue to drive growth in the US. There's also, though, pressure on the Fed chair. So ever since April, the Christopher Waller has differentiated himself at various stages. Whether it's been, his April talk, which was really getting into trying to address bullish and bearish sort of scenarios based on the tariffs. What one scenario will be if when they come in, what the impact will be on the most positive side and the most negative side. At the moment, it's coming in at, I think the average rate, all-in blended rate, supposed to be something like 15%, which has a various impact on inflation based on how much of the tariffs the consumers obviously absorb. At the moment, most of the estimates are that CPI goes up in the US by 1% and seem to be transitionary, just like GST was transitionary for us. So that's what the street's basically pricing in, but there's just so much uncertainty as well.
Yeah.
And the uncertainty can be a real problem. And I know that's what Singapore's really concerned about as well, because you look at our really strong SDI performance, over those 12 months, last half of last year, the first half of this year, you had 5% GDP growth in those 2 quarters and the end of last year, 4% for the first 2 quarters of this year. And it's kind of, you try and think for the next 12 months, but for a very trade-dependent economy, it's like you're in a sports competition and a lot of your key players are leaving or potentially going to another team. So you can't guarantee you're going to win the premiership again next year. So there's big structural changes happening, which mean that we basically are very uncertain where the world's going, and that impact of uncertainty on businesses and in businesses employing and investing and putting capital works to into motion, it could get tested. And of course, that's why for Southeast Asia, for Singapore, domestic demand really trumps. That's what many investors, when you look at the various stocks that we've got, those that are benefiting from more resilience at home are obviously performing better and seeing the better net institutional inflows so far this year.
Yeah, this is one of the US 10-year risk-free is one of the key parameter I'm paying attention to, because this one will derail the S-REIT recovery. Later, I will show you actually S-REIT at the present moment has already reversed into the bullish trend. Okay, the reason being is because for the past 3 years, S-REIT has a very strong inverse correlationship with the US 10-year risk-free rate. Okay, you can see that whenever the 10-year risk-free rate peak, there will be a sell-off on the S-REIT itself, and vice versa. And at the present moment, as long as the 10-year risk-free rate stay high above 4%, most likely the S-REIT, the recovery will be muted unless we see a very strong growth in terms of the DPU. All right, and at the present moment, S-REIT is pretty cheap compared to the bank stock. All right, overall, you can see that from that side basically is the bottom of a PNF price to book of 0.8. That was during the March 2020 COVID crash. At the present moment, we are trading at the price to book of 0.78 times. So you just imagine during that time, the whole world economy has stalled. We're all having a lockdown at home. We are not able to travel, and the price to book is 0.8. Now we are close to that level. So in terms of valuation, it really does not make sense. If everything back to normal, the interest rates start to normalize again and start coming down, I would expect that the S-REIT at least to recover back to the price to book of 1 time. Right, that would be maybe 20% upside potential. While waiting, you are still able to collect a dividend close to about 6%. right? More importantly, is more when we invest in the S-REIT, is more importantly we need to invest when the S-REIT is cheap and also based on the chart itself at the bottom. So this is the REIT index. You can see from here that REIT index has been on a downtrend for the past 2 or 3 years. Then after that, they move sideways in consolidation mode in 2024 and beginning of 2025. And recently, they just broke up from this inverted head and shoulder. If you're able to visualize the inverted head and shoulder, are you able to see where is the head, right? If you still cannot see, okay. Cannot see? Head, left shoulder, right shoulder, right? Inverted head and shoulder is a trend reversal pattern at the bottom of the chart. And recently, they just broke out the neckline, just broke it down, and there'll be a reversal. And that is a clear breakout and also bullish uptrend. Me and Jeff, actually, last month, we are just watching this one closely and just pray, please break out.
Yeah, 1050, right? Which is the IHS REIT index. See that inverted head. That's where retail really got to work in our stock market in those first 2 weeks of April. The retail investors net bought. Retail investors in Singapore net bought 815 million Singapore dollars of DBS stock alone, and that's when your volume weighted average price over those 2 weeks was just $40, and now it's above $50. I think maybe 20%, 25% of that net buying over those first 2 weeks of April has since been liquidated, but it's still carrying through. And the fact that I just wanted to add into that, one thing that has been impacting demand for REITs is the fact that so many stocks in Singapore have been embarking on value up programs and basically distributing what's called value realizations dividends, VRDs. And that's created a much more competitive marketplace for income chasing investors with these pretty high yields. I mean, even Propnex yesterday, right, had a record profit, and the payout ratio was something like 87%.
Yeah.
So that's
record dividend.
Yeah, and that's close. That's basically rewarding investors for their business, like REITs reward investors as well.
Yeah, that's why. If you're an investor, where do you think is the best time to buy? You want to wait for the whole thing to reach rally and the 20 to 30% to go in, or when you buy when everybody is still in fear or still uncertain? The best time to buy actually at the present moment, because technically the chart has already started the uptrend and just started. They have not really go up very fast, and at the same time, based on the valuation itself, they are still pretty cheap. And interest rate has not come down yet. So now is really the sweet spot. Right, so this is the latest earnings. We have not finished the whole earnings yet, but if you look at all the different sectors itself, I just summarize it. Okay, a bit busy this chart because I'm trying to time the turnaround when the REIT sector, the DPO start to turn around, and I am waiting for green color. Green color means it's good. That means the DPO, there's a growth year over year or half over half. Right, in terms of the retail sector and also specialized sector, that means the data center, you can see that they are pretty resilient. At least they are not on a downtrend. They start turning up. For the diversified sector, the result has been mixed. And one obvious turnaround would be the OUE REIT and also the Capital Land Integrated Commercial Trust. They start to turn around. Basically, they benefited from a high interest rate. Hospitality sector has been pretty poor, except the CapitaLand Ascott, the pretty stable based on the latest earnings. And for industrial sector itself, you can see that also pretty resilient, except Mapletree Logistics Trust has been on a downtrend for the past few quarters. In terms of commercial office, US commercial office still not out of the wood yet. One very standout performer would be the Elite UK REIT. They have the commercial office in UK. You can see that there's strong recovery in terms of DBO growth. So this is a snapshot on the latest earning, but based on a different sector now. So what I would expect would be maybe the next 2 or 3 quarters will be better, right? Do you have any comment on that?
Yeah, and just for all the focus on interest rates as well, do bear in mind we're in Singapore. We have one of the world's strongest currencies, and for many of these REITs that have overseas properties, yes, they take their loans in those overseas currencies, but they also have to come back and generally pay the unit holders in Singapore dollars. So when you have a really strong Singapore dollar, you have negative currency translation, which cuts into your return on the investment and cuts into your DPU. One of those REITs that is in the green for year on year and half, I was speaking to the CEO just a week ago, and I said, what do you prefer? A 25 basis point cut from your central bank, or the Singapore dollar to depreciate by 2.5% to that currency? And he said, you prefer for the investors, the unit holders, for the Singapore dollar to depreciate by 2.5%.
All right. Okay, that's all for our session.